If you're like most people, you probably use money every day. You might carry some in your wallet, but for the most part, it exists in digital form in your bank account. For many of us, that's the norm now, but have you ever wondered how we got here? Have you ever wondered how money became what it is today? If not, well, here's your host. Welcome to Life Noggin. Let's find out. So imagine a time before money, like back when humans were trading goods and services. Say, I want to trade this sweet hat that my mom knitted for me for some delicious chocolate. But my friend doesn't want the hat, so I can't trade it for chocolate. This is an example of a barter system where people trade goods and services directly for other goods and services, rather than using money as an intermediary. Bartering isn't a bad idea, but it can be difficult to find someone who wants what you have and has what you want. It also requires a lot of coordination. So as societies grew and became more complex, they needed something better. One of the first examples of a society using money comes from ancient Lydia in present-day Turkey around 600 BC-E. Lydia was a small kingdom in western Anatolia known for its wealth. They had lots of gold and silver, and instead of using them to make jewelry, they started using them to buy things. Lydia became the first civilization known to have coined money. These coins were stamped with an official stamp to guarantee their weight and purity. This innovation spread to other civilizations like China and Rome. In fact, the word coin actually comes from the Latin word for the moon, luna, because the first coins minted in Rome were stamped with the image of the moon goddess. Paper money didn't become popular until much later. The earliest known example of paper currency dates back to the 7th century in China. By the Middle Ages, banks were beginning to pop up, and one of their main functions was to store valuables such as gold and silver. But eventually, instead of keeping their valuables in a bank, people began using checks, which were pieces of paper that gave them a certain amount of value. Then, in the 17th century, the first banknotes were created. A banknote is a type of paper money that is issued by a bank and is backed by the bank's assets. These notes became very popular in Europe and eventually replaced gold and silver coins. In the United States, the first paper money was issued by private banks during the Revolutionary War. In 1775, the Continental Congress authorized the issuance of $1 million in paper money to help finance the war effort. However, this money quickly lost value due to overprinting and depreciation. After the war, the U.S. government established a national bank and began issuing paper money backed by the full faith and credit of the government. This money was more stable than the paper money that had been issued during the war, but it was still subject to inflation and deflation. The first U.S. banknotes were issued in 1862 to finance the Civil War. These notes were legal tender, meaning that they could be used to pay debts and taxes. The first U.S. paper currency was issued in 1914 with the Federal Reserve Act. This act created the Federal Reserve System, which is the central banking system of the United States. The Fed issues paper currency to member banks, which then distribute it to the public. Today, there are 4 main types of currency in the United States: coins, paper currency, checks, and electronic money. Coins and paper currency are issued by the U.S. government, while checks and electronic money are issued by private entities. The majority of transactions in the United States are made using electronic money, such as debit and credit cards. But then the question becomes, how does money exist in digital form? Well, before we get into that, let's take a step back and remember our sponsor. Like money, life can be unpredictable, which is why you need to prepare for whatever comes your way. That's where Policy Genius can help. Policy Genius makes it easy to compare quotes from top life insurance companies in minutes. You can find coverage that fits your needs and budget by answering a few simple questions. Life insurance can protect your family from financial uncertainty. And with Policy Genius, you can find the right policy for you at the right price. Now, back to the video. One of the biggest milestones in the evolution of money was the invention of the credit card. The first credit card was introduced in 1950, and it was called a Bank Americard. This card allowed customers to charge purchases to their account and pay for them over time. This innovation revolutionized the way people spent money and paved the way for the digital age of money. Credit cards work by allowing customers to borrow money from the bank to make purchases. The bank will set a limit for each customer based on their creditworthiness. When a customer uses their credit card, the bank will charge the merchant for the purchase and add it to the customer's account. The customer will then have to pay back the loan plus interest over time. Interest is essentially a fee for borrowing money. It's a percentage of the loan that the borrower has to pay on top of the original amount. The higher the interest rate, the more expensive the loan will be. There are many different types of credit cards, including debit cards, which are linked to a customer's checking account and allow them to spend money they already have. There are also different types of loans, such as mortgages and auto loans, which allow customers to borrow money to buy big items. These loans typically have lower interest rates than credit cards because they are secured by collateral, meaning that if the borrower doesn't repay the loan, the lender can take the collateral. The rise of credit has had a major impact on the world economy. It has allowed people to buy things they wouldn't be able to otherwise afford, like houses or cars. It's also helped businesses grow by giving them access to capital that they wouldn't be able to get otherwise. However, too much debt can be a bad thing and lead to financial instability. For example, when people borrow too much money, it can cause an economic bubble, which is when prices are higher than normal because of high demand. When the bubble bursts, prices crash and people lose money. So what does the future of money look like? Some say that physical money is disappearing and being replaced by digital currency. In fact, many countries are exploring the idea of creating their own digital currency. The Chinese government is leading the way with the development of the digital yuan. Other countries, such as the United States, European Union, Japan, and India, are also looking into developing their own digital currencies. The main benefits of a digital currency are increased financial inclusion, reduced transaction costs, increased security and transparency, and the ability to innovate new types of financial products. However, there are also some challenges that come with digital currency, like cybersecurity risks, loss of privacy, and the potential for government overreach. Cryptocurrency is another example of how money is evolving. This is a digital or virtual currency that is secured by cryptography, making it nearly impossible to counterfeit or double spend. Cryptocurrencies are also decentralized, meaning that they are not controlled by any government or financial institution. Bitcoin is the first and most popular cryptocurrency. It was created in 2009 by an unknown person or group of people under the alias Satoshi Nakamoto. Since then, thousands of other cryptocurrencies have popped up. These new currencies often have unique features and can be used for different purposes. For example, Ethereum is a cryptocurrency that can be used to create smart contracts and decentralized applications. Even artificial intelligence is playing a role in the evolution of money. AI is being used to improve financial services in a number of ways. For example, AI-powered chatbots are being used to provide customer service and answer questions. AI is also being used to detect fraud and prevent cyber attacks. One company even created an AI-powered system that can predict whether or not a loan applicant is likely to default on their loan. This helps banks make better lending decisions and reduces the risk of banks lending money to people who are unlikely to pay it back. And then there's blockchain. You may have heard of it in relation to cryptocurrencies like Bitcoin. But blockchain technology has a lot of potential applications beyond finance. In fact, blockchain can be used to track and manage any type of data. For example, blockchain can be used to track the movement of goods or to track patient medical records. This technology can help improve efficiency and reduce costs in a number of industries. So what does all this mean for the future of money? Well, it's clear that money is evolving and changing rapidly. What we consider to be currency today may look very different in just a few years. Will physical money completely disappear? Maybe. Maybe not. Who knows? Speaking of what you think, leave a comment below. How do you think money will evolve in the next 50 years? We might feature your comment in a future episode. As always, this has been Life Noggin. Don't forget to keep on thinking.